Have markets simply been in reset mode, or do they really need to price in recession? Welcome to Market Insight. I'm David Pollard. Risk appetite appears to be making quite a return to global stock markets after their latest steep sell-off. Fed policymakers have been uttering reassuring remarks in recent days and say they themselves see no recession ahead, but at the same time have given some signals the central bank will need to cut rates to avoid such an outcome. Well, joining me now to talk about all that and some of the day's top corporate headlines is Will Rhind, founder and CEO of GraniteShares. Welcome, Will. Many thanks for joining us today. The market moves of the last few days have been dramatic. Was this simply a wobble, albeit a big one, or are there deeper fears that the markets have to contend with?
I think for the moment, this was really all about what happened in Japan. Yes, people will point to the weaker US jobs number that came out on Friday, but I think that was just a symptom and not the cause. The cause was the reversal of the yen carry trade, which was sparked by the Bank of Japan raising interest rates, which took the market by surprise and led to a big unwind with investors that have borrowed money in Japanese yen where the interest rate is effectively zero, and then use that money to invest in other assets, namely US stocks all around the world. And we saw a big unwind, which led to that selling, which really sent the market into a tailspin on Monday.
So do you dismiss fears around recession?
But yes, at the moment, for me, I don't think that this is a fundamental economic problem. This was much more of a technical thing related to the unwinding of the carry trade. So for me, the economy is still largely in good shape.
So what sectors and big names are likely to be the winners after these recent gyrations, now that we have a rebound in stocks?
I think that we'll revert back to the trend that we have largely seen, not just over the last few years, but perhaps even the last decade or so, minus the brief interruption that we had when the Fed had repriced everything back in 2022, which is large technology companies, particularly in the fields of AI, in other large technology sort of fields. Those, I think, are the companies which have generated or are generating the most in terms of revenue, in terms of profitability. They have the sort of dominant market positions that people really like and have that quality factor that people are looking at in an environment where we have elevated inflation and interest rates.
So what do you make today of the rather mixed messages that we're getting from the chip making sector in particular? We've seen a big rebound in Nvidia, but Supermicro are down around 12% today on worries over the cost of AI chip production.
Well, what we've seen over the last few weeks, and I would say really from the beginning of July, is volatility has picked up in the market. And over this second quarter earnings season, what we've seen is that the market is really starting to punish companies that are under delivering on earnings expectations. So even companies such as Google, which really had, I think, what all people would consider to be a good second quarter earnings, were punished just because they missed slightly in terms of YouTube ad revenue. And so I think the market is in a position where it's really punishing companies due to the elevated volatility levels that are missing on a little bit. So we've seen that with some of these companies that you just mentioned.
Well, Walt Disney possibly falling into that camp a little bit, but also worrying investors because its profits are down at its theme parks. What does this tell us about Disney and also about the US consumer?
I think when we talk about certain Disney, Disney beat earnings expectations. So the good news is that the streaming business and the digital businesses seem to be getting much better. The less good news was, as you mentioned, the theme park revenue slightly down. And I think that does indicate that there is some weakness in the consumer. But when we talk about the consumer, I think it's important not to talk about consumers holistically. We have to really bifurcate the consumer into those consumers that are effectively immunized to some degree from inflation, and those that are very highly sensitive to inflation, which of course would be those at the bottom or closer to the bottom of the socioeconomic pyramid. So those people suffering much more from the effects of inflation and therefore much more sensitive from a consumer perspective, much less willing to spend money in this environment. And I think when we talk about consumers, we have to start thinking about the different consumers in the market, because some are affected much more dramatically by inflation than others.
So with that in mind, let's finish on the Fed. Is it unreasonable to suppose that they might be considering a 50 basis points cut in September?
I don't think it's unreasonable. I think that the stakes have got a lot higher now with what happened on Monday with the Bank of Japan and the global asset sell-off. I think that there are some real signs that the labor market is weakening. Again, the bigger picture is we still have very low unemployment rate by historical standards, but there are signs that that is weakening. And I think that is largely due to the effect of higher interest rates, leaving rates higher for longer, and companies factoring that into hiring decisions going forward. And so I don't think it's unreasonable to believe that we could get a 50 basis point cut, but I think certainly we probably are now going to get more interest rate cuts than the market was expecting even just a month ago, which was really largely just a 25 basis point cut perhaps before the end of the year.
Okay, we'll leave it there. Will Rhind, founder and CEO of GraniteShares, many thanks for being with us today and sharing your thoughts. That is your market insight. You can watch more videos on Reuters.com.